Hi guys, welcome to Commerce with Dr. Arpita. Today we are going to discuss a very important topic, equity valuation and analysis. Now, what is equity analysis? How do we value it? What are the formulas we are using in it? Where we can use these things and how to value the intangible assets. All these things we are going to cover in this topic. So let's start with today's topic. Now, what is equity analysis? First point. So, equity analysis is basically doing the research about a particular company's stock. Okay, how much it is worth, its true value. Okay, valuation is basically a part of equity analysis for calculating the true value of the stock of company. Now, I have prepared a very beautiful story for understanding this concept of equity analysis and valuation. And the title of our story is It a Good Deal? So imagine that you want to buy shares of a company and those shares are valued at 100 rupees per share. Okay. So what are you going to do? Are you going to straight away purchase those shares, or are you going to do some research before purchasing those shares of a particular company? Well, let's see this in our story. Now you have two options. Okay, so option one says that the company's stock is undervalued by 20 rupees because through your analysis and research the price of the stock is 120 rupees, but actually it is showing as 100 rupees. And the option 2 says that the stock price is rupees 80 through your analysis and research. That means that the price of a stock is overvalued. So this suggests that the undervalued stock can be purchased. Like if we go with option 1, the stock can be purchased, but if we go with option 2, the stock must be ignored because it is already overvalued. Okay, now anything which is overvalued than its price. So for example, if you go to a shop for purchasing a shoe, but if you see that the price of the shoe is 3000 rupees, whereas the actual price should be around 1000 or 1200 or 1500, so that means the price is overvalued definitely. So you will try to ignore that, right? Not purchase it even after knowing the true value of those shoes. So same happens here in the case of shares. So I hope it is very much clear what is undervalue, what is overvalue, and how to differentiate among the both and how to take the decision. Now, now I have prepared a set of 10 most important FAQs on equity valuation and analysis. Let's move on to those FAQs. Question number 1. How do intrinsic value and market price relate to investment decisions? So first of all, intrinsic value, we've already discussed that it is the real worth of the company's stock, and the market value is what the current trends and current market price is prevailing in the market of that particular stock. Now, in the case that how do they relate to investment decisions is that it tells us whether to purchase that particular stock or not. As we have already discussed, that if intrinsic value is more than market price, then the stock price is undervalued. Okay, that means we should buy that particular stock. If the original price is more than the market price, then it is overvalued. And in opposite case, when it is the intrinsic value is less than market price, then it is overvalued and it should be, if you are holding it already, you must sell it. Coming to question number 2, what is DCF? DCF is discounted cash flow model. So what it does, it calculates the company's the stock's intrinsic value by discounting its future cash flows back to their present values. Okay, how much it will be worth in future, using the discounting technique it calculates its present value. And see, we can see this through the formula DCF is equal to CF1 upon 1 plus R. It is showing of various number of periods. So DCF basically discounted cash flow, CF is cash flow period for I, uh, then interest rate is R, n is the time in years before the future cash flow occurs. Yes, the most common DCF models are discounted dividend model, free cash flow model, and there are more classifications under these. Coming to our question number 3, what is relative valuation? Well, relative valuation is second. is one another approach of equity valuation as DCF valuation. So relative valuation, and it is mostly it is suitable for those companies which are showing negative growth. Now, uh, what it does is it compares a company's valuation ratios. So what are the valuation ratios? P, PS, and PB. So price to earnings is basically current market price of the stock divided by earnings per share. So that is your price to earnings ratio. It indicates how much a investor is willing to pay for each dollars of a company's earnings, and a higher P ratio indicates that the investors expect strong growth of the company, whereas a lower indicates that the stock prices are undervalued in the market or facing financial difficulties. Now, price to sales is basically market price of the share divided by the company earnings. Okay, that is through the revenues, that is through sales, what earnings. Now, in this same thing happens that if it is higher, then the uh, investors expect a strong growth of the company, but if it is low, then that means the stocks of the companies are undervalued. Coming to price to book is basically the net assets, so a book value. So basically what is that is, it is actually the opposite of PE and PS. In this, if the PB ratio is higher, then that means the stocks are undervalued. So this was all about relative valuation, basically to determine whether the company's stocks are overvalued or undervalued, same as in the case of DCF valuation. Now, coming to fourth question, what are some key financial statements used in equity analysis? Now, every time when we are talking about finance or accounting terms, the financial statements are always coming up. So let's understand once for all that what are income statement, balance sheet, and cash flow statement. Well, income statement is basically the report card of the financial performance of a company. It it tells about the revenues, the expenses, profits, or losses made by the company. Balance sheet is basically the financial snapshot of the company or for a specific point of time. Now, it indicates through assets, liabilities, what a company owes and what a company owns, and how much is the owner's stake in the company. That is the equity. So that's the balance sheet. Cash flow statement basically shows the inlet and outlet of cash by the firm through investing activities, through operating activities, and through financing activities. Okay. Moving to our fifth question, what are some important qualitative factors? Well, qualitative factors include company's management quality. How a company is managing its staff, managing its works, operations, transactions, and everything. That shows what a company's quality is. Uh, Competitive advantage. Well, guys, what is moat? So what happened in medieval ages, they were castles, okay, and castles were built um in such a way that its boundaries were covered with water. Okay, so there was like water around the castle, just to prevent from enemies attacking the castle. Now, same has been used in terms of competitive advantage, that how much a company is able to protect itself from the other competitors in the industry, prevailing in the industry. Third is industry trends. So what are the trends of that particular industry? So okay, regulatory environment, whether the industry or particular firm is regulated by the government or not. Coming to our next question, question number 6, how do you value intangible assets? Well, what are intangible assets, guys? It is the copyright, the trademarks, okay, the patents. Now we can't touch them, but they are our assets, okay. So, uh, how do we value these assets? Well, there are three approaches towards that. That is cost approach, market approach, and income approach. Now, cost approach is basically knowing about the cost of the intangible assets, like how much it costed to reproduce that particular asset. Okay, market approach is basically valuing the same kind of intangible assets prevailing in the market. Okay, and according to that, we will value the intangible assets. Last is income approach. So income approach is all about estimating the future cash flows attributable to the intangible assets. Means with the help of intangible assets, what all cash flows could be generated in the future. Now estimating that cash flow and then discounting them back to their present value is the process of mark income approach. This is quite complex to calculate, but to understand the basic concept is what I'm trying to deliver here. So yeah, let's move on to question number 7. What are some common valuation ratios? PEPS, PB we have already discussed in above slide. EPS is basically the earnings per share. How much per share it is the earnings are. EPS is equal to net income minus preferred dividend, the whole divided by number of shares outstanding. Okay, that will give us the EPS. Next is return on equity. So return on equity is basically net income upon shareholders equity. Debt to equity is basically total liabilities divided by shareholders equity. So these were some common valuation ratios. Moving on to question number 8, difference between growth and value stocks. Growth stocks are those stocks which are strongly expected by the investors that it will grow in the future. They are basically overvalued and are shows high growth rates in PS and PB, all these ratios. Whereas the value stocks are those stocks which are not expected to grow highly, and the main source of their income, those companies who issue value stocks are main source is dividend and are basically it is undervalued. Whereas the main source of income for growth stocks are capital gains. Moving to question number 9, purpose of sensitivity analysis in valuation. Now sensitivity analysis is something that will give us the uh, critical assumption or critical factors that are responsible for key changes in the valuation. Okay, now it shows that how these factors or these assumptions are affecting the valuation. Now that's the purpose of sensitivity analysis. Last question asks us, last question is that the challenges. Now basically these challenges are very similar to the challenges we discussed in the our previous video of time value of money. So same will go here, because actually calculating equity is very complex process, guys, and estimating the discount rates, estimating the future cash flows are not very easy task. So, and of course uncertainty is always there whenever we are estimating anything. So even after proper calculations there could be uncertainties. So that's all about the question parts, FAQ part. Moving on to our case studies where we can use this particular method, where we can use with equity analysis and valuation. Case study number 1, if we have to compare two companies in the same industry, we can use relative valuation. Okay, so in which to invest, in which not to invest. Valuing a startup, since a startup is a very new company and the records and data of financial data of that startup is not available, uh, that's why it becomes complex to value. But with the help of DCF and other valuation process, we can value a startup as well. Also we can analyze a company's financial health by valuing its ratios. Okay, we can make an investment recommendation through equity analysis and valuation. When we have done so much research about companies stock prices and other stocks, we are able to recommend whether this company is going to perform well or how it is performing in the market, current trends of the company, etc. So whether to buy those shares or sell the shares, whether the shares are under, like on these things can recommend. Last is portfolio management. Definitely, when we know enough about the company's stocks, their prices, and everything have been researched and the homework is done, so managing a portfolio becomes a very easy task. Thank you so much everyone for watching this video. That's it from my side. If you feel any content needs to be given in a more detailed form, then you can just mention it in the comment box, and any FAQ, any case study or any meaning you need to explain in a more detailed and more clear form, please mention in the comment box so that I can make a video on it as soon as possible and upload it here. And if you find anything useful for you in this video or and your academics, just like it, share it, and subscribe my channel. Thank you so much for watching the video. See you in the next video. Bye bye.